Hi, everyone. What would it take to retire in 10 years? That was the question I started asking myself last week. The average person thinks about retirement in terms of decades. They save their money, they add to their company's 401k plan, and just the thought of being able to retire in 10 years seems really out of reach. And especially if you have zero assets. So, no savings, no liability, you're starting from zero. Well, with a little help from AI, I use Grok, Gemini, and OpenAI. I took a look at that question, and I think the answer might surprise you. I believe it is possible to retire in 10 years with zero assets. And in today's video, we'll look at how. Hi, I'm Aaron. Welcome to RealFi Talk. On this channel, we talk about the ups and downs of financial independence, how to achieve it, and how to sustain it. If you like this type of content, please like and subscribe below and share it with a friend. Also, please leave a comment. I review all comments and will respond. Thanks. Let's get back to it. So to start with, we need a formula. If we're going to retire in 10 years and we have no assets to begin with, but we have a job, that's a good start. But we really do need to look at how simple this can be and how complex it's going to be. I kind of broke it down into three areas. To start with, I think a minimum requirement to be able to retire in 10 years, you need a good job. It needs to be steady, and it needs to pay you more than enough to live off of. You need to be able to generate some real savings from this. The second element of this is you need to have a high savings rate, one that's probably really uncomfortable, but will allow you to collect and save those assets and savings faster than you've ever imagined. And the third, you really need to avoid lifestyle creep. So as much as possible, you need to keep your expenses fixed. When you put these three things together, you can reach your FI number and retire in just 10 years. So what is the 10-year FI equation? And I'm not saying this is going to be easy. Most people think saving 10% is the gold standard. But at 10%, you have to work 9 years just to pay for 1 year of freedom. When we flip the script to a 66% savings rate, the math does something magical. Since you're living on only 34% of your income, every dollar you save is actually worth nearly 2 years of your living expenses. This is the escape velocity formula. You aren't just saving money, you're buying back double the time you spent earning it. The trade-off? Well, you must live below your means. A 66% savings rate requires one, a very deliberate lifestyle to keep expenses low, and or two, an increase in income without lifestyle creep. The time is bought because your cost of living is so low relative to your savings. Now, many of you might be saying, that's impossible. How could I ever save 66%? I'm not saying it's going to be easy. And for some of you, that might mean lowering some of your expenses, getting rid of high-ticket items. That might mean selling that expensive house or getting rid of those expensive cars, but it is possible. So let's look at this chart. And I'm going to use an example throughout this video that stays the same. Let's say the goal is to build a $1.5 million portfolio that can safely support $60,000 per year in retirement spending. And I'm applying the 4% rule here. Here's how different savings rates impact how long it would take to reach financial independence, assuming you start from zero and follow the equity glide path. So you can see your savings rate at 10 years is going to be 66%. If you want to retire early in 15 years, it'd be 37%, 20 years, 23%, and so on. So you can see that savings rate, it has a pretty big impact on the amount of years. And the 10 to 15 is a pretty big jump. So for some of you, you might say, Well, 10 years is just unrealistic. I can't do 10 years. But 15 years, that might be realistic. That could also work for you. The higher your savings rate, the faster you reach that $1.5 million and financial independence, and even moderate increases in your savings rate can cut many years off your timeline. So which savings rate feels doable for you? Time and consistent saving, combined with equity-heavy glide path, make a really big difference. So the biggest fear is that your money is locked up until you're 59 and a half for many people. Think of your assets as 3 buckets. Your taxable brokerage is your immediate bridge. It funds the first few years. Meanwhile, we use the Roth conversion ladder to move money from your 401k to your Roth IRA. And after a 5-year waiting period, that money becomes accessible penalty-free. And if you need a guaranteed paycheck right away, the 72T rule lets you tap your IRA immediately. Your money isn't locked. You just need the right key. Now, I won't go too deep into this, but I wanted to just show you, for those who have questions about how to access money, it is possible. So let's look at this chart. Think of your income as a river. Most people let it flow straight out to expenses, but we're going to divert it through a series of wealth gates. That first gate, the employer match. This is a 100% return on your money. Never leave it on the table. That would be like contributing to a 401k in the private sector. The second gate, the HSA or health savings account. This is the only triple tax advantaged account in existence, at least in the US. It's a dedicated bucket for one expense that's guaranteed to rise, healthcare. Your third gate, the Roth or 401k, this is your long-term engine. And the final gate, the taxable bridge. This is arguably the most important for a 10-year retiree. This is the unguarded money that you can spend the moment you quit at age 40, 30, or 50, filling the gap until your other accounts become accessible. The key point here is efficiency. You're filling the most tax-efficient buckets first to ensure your $1.5 million is actually spendable money and not money the IRS owns 30% of. So I mentioned this glide path, and some of you might be wondering what it is. So in years 1 through 7, we're in aggressive growth mode. We are going to be putting all of our savings into 100% equities. We want the market's full power. But as we approach the finish line in years 8 to 10, we shift and we introduce what I call the 20% bond cash shield. Why do we do this? Well, we want to avoid sequence of returns risk. And if the market crashes the day you retire, you don't want to sell your stocks at a 30% discount. You spend from the shield while the market recovers. Now, I will put an asterisk on this. What happens if in the first 5, 6, 7 years, there's a big downturn in the market? Yes, that might mean that your path to 5 might take a few years longer. But even the worst recessions, I think the worst one probably lasted about 10 years in the US. A bad one is considered 4 years, but many only last a few months. So I do think it's possible. Okay, let's talk a little bit about the sequence of returns shield. So the biggest danger to a 10-year retirement isn't a market crash. It's the market crash at the wrong time. And this is called sequence of returns risk. If the market drops 25% the year you retire and you're forced to sell stocks to pay your bills, you're really cannibalizing your portfolio. You're selling at the bottom, and those shares can never recover. The 80-20 shield is your insurance policy. When the market is in the red, you stop selling stocks entirely. Instead, you spend from the 20% defensive bucket of bonds and cash. This gives your 80% growth engine the 2 or 3 years it needs to bounce back without you ever touching a single share while it's down. We aren't just investing, we're defending. The key point here, it's psychological and mathematical survival. The shield prevents a paper loss from becoming a permanent loss. So again, this isn't a vague dream, it's a schedule. Year 1 is about 66% automation. Year 5 is your bridge check, ensuring you have enough outside of retirement accounts to last 5 years. And year 8 is the portfolio shift. And by year 10, the math is done. You aren't retiring from a job, you're retiring to your life. So thanks for watching this episode. And for me, this was a fun episode to do. I went off of my kind of standard reviewing of articles that I've been doing lately, and I used AI to figure out if this could be modeled. And I know these are big asks, right? 66% is a huge savings rate. But I did want to share that it's possible. And for those of you who really want to accelerate this financial independence journey, maybe you can take some of the tips from this video and apply it. Again, this is for fun and educational purposes only. I'm not a financial advisor, and please connect with a professional if you choose to make these moves yourself. All right, remember to like and subscribe, and we'll see you next week. Have a great day.